Now, there have been some indications that the US economy might not be performing quite as well as we thought. Last year, the US economy was pretty much the growth story of 2014, and lately we've seen US stocks perform increasingly well. But there is a bit of uncertainty when it comes to the US economy. So with us on the line now is Jonathan Davis, Managing Director at Jonathan Davis Wealth Managers and Independent Economist. Good morning, Jonathan.
Hello, Sandra.
So exactly what is going on in the US? Because we're getting a bit of a mixed picture at the moment.
As you say, underlying the headlines, things are not nearly as positive as most of the media would have people believe. I could, rattle off a list of economic statistics. I'll give you a couple, and you'll see whether or not you want to go further. Take housing starts, for instance, which is building of new housing. In 2007, at the peak, or just after the peak, they were building at the rate of 2.1 million a year. At the bottom, at the end of the recession in 2009, it was down to 500,000 a year. So where are we now? Well, last year it was 1.1 million a year, which is, of course, is about half of the peak. And now it's running at the rate of 950,000 a year. The point is, housing starts are less than a half of where they were several years ago at the peak, and they're falling. This is obviously not good for the economy. Then you look at, say, for example, Empire State Manufacturing Index. It's down 1.2% year on year. Clearly, manufacturing is going down. Manufacturers' Purchasing Index of inflation down 7% year on year. That kind of statistic is actually recessionary. I could go on, but there are so many economic statistics in the United States which suggest that the stock market is in cloud cuckoo land.
But Jonathan, can we really depend that much on the data? I mean, recently we've also been talking about that the markets are almost too influenced by data, that they're so volatile at the moment that they'll jump just at the slightest negative data. I mean, can we really rely that much on those statistics?
The market is not the economy. It never has been, and it never will be. And those who say that the economy will determine what happens in the market are entirely incorrect. I was about to say another phrase there, but inappropriate for the radio. And the point I'm making is that although these economic statistics have been lackluster at best and in some cases dire for the last 12 or 18 months, the stock market has continued on its merry way. And probably that's because of the continued zero interest rate policy, and also because of the recent quantitative easing, money printing, which goes straight into the stock market, and also because of massive, humongous share buybacks by large public companies. So no, I'm not suggesting that the economy will determine what's happening in the market. What I would, however, say that eventually, the market does tend to catch up with the real economy.
It's interesting you just touched on the stocks there, Jonathan, because that's one of the things that doesn't quite make sense when you look at the US at the moment, because you are right, the latest data sets from the US haven't been quite as good as we'd like them to be, and at the same time we're seeing pretty strong numbers coming out of stocks. I mean, just take overnight, and on the front page of the Financial Times this morning, we have two of the major banks, Goldman Sachs and Citigroup, reporting the strongest quarters since the financial crisis. I mean, doesn't that have any sort of effect on the economy, or does it just not matter that the US stocks are performing well?
The banking stocks, which I want to focus on there, as you have, rather than the general stock market, the banking stocks are roaring ahead, and again, that's because of the ongoing financialization of Western economies, particularly the US and the UK. I would caution your listeners that banking stocks were roaring ahead in 2007, and we saw what happened next. In other words, it does tend to be the case that when the banks are peaking, that's also when the stock market is peaking. I'm not saying that the banks are peaking right now. I would say there's a cautionary note that people should not associate soaring bank stocks with an ongoing soaring stock market.
Finally, Jonathan, just to ask very quickly, we are expecting some sort of interest rate hike from the Federal Reserve, but with these negative data, is there any suggestion that we might not see that this year as expected?
I take issue that we're expecting interest rate hikes. The market, the futures market for interest rates isn't expecting an interest rate rise from the Fed until early next year. And indeed, if I can just add to that, in the UK we're looking at the end of next year, and in the Eurozone we're looking at 4 or 5 years out. So no, we're not expecting interest rate rises. And when you consider the dire state of government finances in the US, UK, and in the Eurozone, the vast amount that our illustrious governments owe on our behalf, when you consider how much interest they have to pay on that year on year, in the UK alone, it's approaching £50 billion a year just to pay the interest. The idea that central banks in the West can raise interest rates sustainably for the next 10 or 20 years, I think is cloud cuckoo land time. I wouldn't be surprised to see maybe an interest rate rise in the medium term, but that's only because the central banks have been saying that they're going to raise, and they've been for the last couple of years, and they've been talking codswallop for the last couple of years, because there's no way that they can do so when actual global market rates have been plummeting for the last couple of years. The only reason why they'd raise rates is to save face, because they've been talking nonsense for the last couple of years. But I tell you, and your listeners, if interest rates rise in the West in the medium term, they will not be sustained. They will come straight back down. We can expect that interest rates will stay low or practically zero for the next 10 or 20 years.
Jonathan Davis, Managing Director, Jonathan Davis Wealth Managers and Independent Economist, thank you for being with us.